Hello, welcome.
Hi.
Welcome. Thank you so much
Yeah.
for joining us. Um, so for anyone who needs the French captions, you'll find the show captions, translation button, everything at the bottom of the screen. Si vous avez besoin d'activer les sous-titres, tout ça est en bas avec le bouton CC ou sous-titres. So hello, welcome. Thank you so much for joining. My name is Ari Campbell. I'm the program manager of the Healthy Capital program at the Canadian Coalition for Green Healthcare. And on behalf of the coalition, I'm so happy to welcome you to today's virtual roundtable for hospital foundations, integrating climate and sustainability into investment activities with case studies, testimonials, and a preview of our upcoming community practice. So before we begin, I'd like to take a moment to acknowledge with respect the Indigenous peoples and communities whose enduring relationships with the land continue to this day and on whose traditional territory our work takes place. We invite to share where you're joining us from, and if you're comfortable, to include the organization, foundation, or institution you're with in the chat. As someone newly settled in Hamilton, I've been reflecting on the dish with one spoon covenant and kind of what it means to be added as a settler to a pre-existing friendship agreement and what it means for me now as I kind of continue learning about my new responsibilities and environment. Just a few notes before we get started. So if you have any tech issues, just feel free to message us in the chat. If you can remain muted during presentations. And then if you have questions for our speakers, you can use the chat box or make a note and we can kind of address them during our moderated discussion at the end. You'll also be able to raise your hand at that time and if you'd like to speak. We're recording today's presentation portion only, and then that will be shared with registrants and posted on the YouTube, so the discussion portion won't be recorded. This session is hosted by the Canadian Coalition for Green Healthcare in collaboration with the Trottier Family Foundation, Peach Health Ontario, the Canada Climate Law Initiative, and Quinn and Partners. So I'll start today by introducing the program. So first we'll review and introduce the Healthy Capital program. Then over the course of the session, we'll focus on case studies and expert testimonials from both Karel and Ayo that highlight real world successes and lessons learned in their work. We'll also present the community of practice, the supported space for Hospital Foundation board members, staff, and finance leads. And then finally, we'll wrap up with the Q&A session portion where you'll have a chance to ask your questions, share your thoughts, or give us your comments and honest opinions. Our objective today is really to kind of inspire next steps in sustainable investing and to highlight the resources and the supports that we want to offer you through this program and to help kind of turn those ambitious goals into actions. So to start a little bit about the Healthy Capital program, I'm thrilled to kind of highlight our incredible leaders behind the program. So each bring deep expertise in sustainability, climate, healthcare, and philanthropy. So first we have Dr. Miles Sargent, Executive Director of the Canadian Coalition for Green Healthcare at McMaster University. He serves as the Postgraduate Medical Education Director for Sustainable Healthcare. He's the Assistant Clinical Professor in Family Medicine and co-founder, co-lead of Peach Health Ontario. Outside of McMaster, Miles also leads the Hamilton Family Health Team's Green Initiative and serves as the president of Trees for Hamilton, among many other contributions to greening Canada's healthcare system. And from the Trottier Family Foundation, we're honored to be joined by Flavie Desgagnés-Etier, an expert in corporate social responsibility and climate philanthropy, and a lecturer at the University of Montreal. The Trottier Family Foundation is the funder behind Healthy Capital and has a long-standing commitment to supporting impactful climate initiatives. And with that, I'll hand things over to Miles Sargent.
Thank you very much, Ari. And sorry, I've got a bit of a funny screen here. I was having some technical problems getting on my laptop. So here I am on my desktop. Thanks for coming, everyone. And please take a look at this slide. I'm going to say a few more things about myself. Yes, I am a family doctor. I like to reassure everyone right at the beginning, I will not be giving you any investment advice. I know how to stay in my lane. So what am I doing here as a family doc? So as the executive director of the Canadian Coalition for Green Healthcare, we scour the healthcare system for places that we can decrease greenhouse gases. The healthcare system in Canada is 5% of all of the greenhouse gases in Canada, which is pretty shocking. It's actually higher than the airline industry. So I'm simply always looking for where can we do better. And this is one place we can do a lot better by switching our investments into what we call healthy capital. You can see the objectives here. This is a project extending from 2025 to 2027. Next slide, please, Ari. A number of different countries have looked at the carbon footprint of their healthcare system. So this is just the healthcare system. This is the various pieces of the pie. I'm using an American public health system pie chart here because they have included investments. Sometimes these don't include investments. And so you can see in blue at the top that supply chain, which is called scope 3 stuff, all the stuff we buy is a huge, huge piece of the pie. So that's one thing that we certainly spend a lot of time on in the coalition, is trying to find, products that we can buy that don't have so much carbon. But then interestingly, number 2 on the chart here is investments, 28%. So I don't need to tell you, there is no investment that is 0%, carbon. But we can do a lot better than 28% in the system. So this is a piece of the pie that we can definitely squeeze down. Next slide, please. So where are we in this project? We did start in late 2024, sending out a survey to get a landscape review of where different foundations are at. And here we are with the foundation board engagement section. And so raising awareness, hopefully creating a community of practice. I know this does not feel, let's just say, I know this is nerve-wracking for some boards to go down this path. We don't think you need to be nervous about this. So hopefully we can educate you about that. And Ari, thank you. I will pass it back to you.
Perfect. Thank you so much, Miles. So I'm so pleased to welcome our first guest speaker, Karel Mayrand, President and CEO of the Foundation of Greater Montreal. Karel is a longtime leader in environmental and social change and has been a driving force in connecting climate action with community solutions. He served over 12 years as the Director General for Quebec and the Atlantic at the David Suzuki Foundation and is the former chair of Al Gore's Climate Reality Project in Canada. He's also a published author, public speaker, and frequent contributor to La Presse and L'Actualité. Karel has advised several UN agencies and Quebec's former premier, Pierre-Marc Johnson, on globalization and sustainability. He also co-founded Unisfera International Center, a sustainability think tank where he launched Planétaire, one of Canada's leading carbon offset and climate solution providers. And so we're very excited to have him with us today. Thank you so much, and over to you, Karel.
Thanks, Harry. Thank you, everyone. So I was listening to Miles about the kind of where emissions from health institutions were coming from, and it reminded me when I joined my organization 5 years ago, almost to the day. I was an environmentalist. I still am an environmentalist. Like, I'm infiltrated in philanthropy now, but so when the team saw me as a new boss, they said, "Listen, you're going to be proud. We're going to go carbon neutral." And so, our foundation is 20 employees, 5,000 square foot of office space. We don't have that much of a carbon footprint, but we do have an endowment. And that endowment is now about $500 million. And that's where 98 maybe % of our carbon footprint is. So I told them, we're not going to start, telling people that we're using recycled paper and stuff like this, and we're not going to talk about greening our operations. Like our core business is investment, so we need to clean up our investment. That was the first element. The second element is, and I think it's important for us to take a pause when we work in philanthropy. Philanthropy works with two brains. There's the brain that invests money and doesn't really care if it's destroying the planet or hurting people or hurting First Nations territories or communities. And then there's the brain that grants money and does good things. And those two brains function, separately. And so on the one hand, you like the way you're investing money will hurt people that you're trying to defend. And we could find plenty of examples, definitely on carbon and climate change. But say you invest in a company that uses slave labor in a global South country, and then you try to support refugees here. It doesn't make sense. Same thing for child labor and helping education here. And so we don't really, and I think it's a problem in philanthropy. So the second thing we did is I said, we're going to have one set of values for the entire organization. If our purpose is the well-being of community in perpetuity, because we create like funds, donor advised funds in perpetuity, then we need to do something on how we invest that money, and is it compatible with our value proposition? And definitely the climate issue becomes central, because I tend to do that joke and no one laughs, but like perpetuity is not what it used to be. It's very difficult for us to have visibility over 50 years from now, because we're actually jumping off a cliff climate-wise. So that's my introduction. And so now that we've set and so it all started with new leadership, right? I came in and I said, let's work on our endowment, our investment, our endowment. That's where our carbon footprint is. And let's have only one set of values for the entire organization, whether we are an investor or a grantor. So who are we? We're a community foundations. We have $500 million, almost $500 million in assets under management. We are a fund of funds, right? A community foundation is many organizations, individuals coming together instead of creating each their separate foundation. So we have 800 philanthropic funds. We grant about 17 million per year. And last year, and that's an important piece, because last year our gross return was 16.1%. And over 5 years, I think it's around 7 point something. But last year is the most important one, and you'll understand later why. So maybe we can move to the next slide. So I joined in June 2020, and we took a year to adopt, a little more than a year, 18 months to adopt a responsible investment strategy. In October 2021, and we did it almost the same month. Well, the same month we adopted our strategic plan, so it was kind of done in parallel. So our goals were not that complicated. So we wanted to have, like we said, 100% ESG investment. Our result 5 years later, 4 years later, 3.5 years later, I should say. No, it's 3 years, sorry, December 31st, is 94%. 5% of our portfolio in impact investment, we were at 2% in December. We wanted to reduce our carbon footprint by 45% by 2030, because it was the target that was aligned with the science in the Paris Agreement. We exceeded that target in 3 years only, and it didn't hurt. And that's the thing. We did this in 2024 when we transitioned our portfolio to a new manager and a new consultant. So we did this last year, and still we got 16.1% return. in that same year. So there, we didn't leave money on the table. You know, people who are the old school investors will say, "Oh, there's a fund holder at our foundation who works for a community organization who once told me, I'm not going to lose money to save the planet." That's exactly what he said. And I was like, okay, it's good. You're going to have lots of money, but no planet anymore. But the thing is, we're not losing money. Reduce the portfolios. No, sorry. We wanted to favor local managers with equal talent because we are a place-based foundation. A community foundation is based in a community. Montreal happens to be a hub of sustainable finance. So we said, why not support our managers? And promote best practices and respect for human rights, indigenous people, reconciliation, justice, equity, diversity. So, so these are our kind of responsible investment goals. We can move to the next one. And so again, we were very proud to reach our climate goals. So now we're on a path that will lead to further reductions in our carbon footprint, which is very good. Next one. So how we got there. So again, the trigger was really changing leadership. So when I joined the foundation in 2020, I said, this is important to me. I was lucky enough to have a very progressive board of directors and investment committee. Actually, the chair of my board at the time, Cathy Fazel, is an expert in ESG investment. She works for PH&N. So that's RBC, within the RBC structure. And she knew what I was talking about, and she knew it wasn't rocket science, and it wasn't something fake, flavor of the month. So I had support from the beginning. So what we did, we started with a board training by the Canadian Climate Law Initiative. Why is that important? It's important because one of the kind of obstacles to sustainable investment is that board members or investment committee members will consider that if they go beyond risk and return, they are not fulfilling their fiduciary duty. They are actually overreaching or like considering elements that are not part of their primary duty. And in the past, I say 5-6 years, that notion has been reversed. Now like climate change has become such a systemic risk and a physical risk, and like there are all kinds of risks that you need to consider that are climate related. There are opportunities too, and if you're not looking at these, you're actually not doing your job correctly. It's as if climate change is as if you would not consider AI. You say, oh no, AI is not part of my fiduciary duty. No, we know that AI is going to have an impact in the entire economy. Climate is the same thing. So that was very important in terms of kind of building comfort with our investment committee and board that they were performing their duty correctly. Then we hired consultants to develop our responsible investment strategy. We got stuck because our consultants said, you know, what are your investment values? And my committee would say, well, we can't tell what our values are without knowing how to implement those values. And so it was kind of a chicken and egg thing. It took us we really stumbled on that until a new chair on my investment committee said, let's do the two things in parallel and unlock this issue. We adopted our responsible investment strategy in October 2021. It was incorporated in our investment policy. That's important. We have like one investment policy. We have a kind of a standalone responsible investment strategy to explain in plain language what we want to achieve. But the master document is our investment policy. So we incorporated everything in our investment policy. We have an investment roadmap. We ended up in 23-24 realizing that the way we were structured with our OCIO structure, like our consultants, our manager could not deliver what we needed. And so we had to shift to new providers. And that actually took us 18 months. So it was very frustrating because we had these great goals, but we couldn't do anything because some people face resistance from their board or their investment committee. Our resistance was from our consultants who would actually charge us extra to do this work, and sometimes would not consider our new filters, I guess, and our new approaches in the investment they were proposing to us. So there was kind of this disconnect or misconnect that we needed to fix. So we hired Normandin Baudry as consultants and Industrielle Alliance as a manager. What's important here is we are in an open structure. Comment on dit, Rosalie, une plateforme, an open platform. So we actually, we used to be restrained in what we could do. So it was very difficult for us to support local managers. We didn't have access to all the products in the market. Now we're in an open structure. We have consultants who understand what we're trying to do and are doing the extra work because they're also developing their own expertise by supporting us. And so in 2024, we did a transition portfolio because we had to move to the new structure. And so then when you do this, you start moving things in your portfolio, and it provides an opportunity to improve things very quickly. And maybe we can move to the next slide, and that's, I think, this last slide. So what we did with that transition portfolio, and the transition is not over yet, but what we did, that allowed us to reduce our carbon footprint was we reduced exposure to emerging markets, and we chose new managers for the emerging markets portfolio. We also had an index strategy in Canada, and we replaced it with a zero fossil fuel active strategy. And that's an important part, many, when you start doing this, seriously, you're going to have to let go of some of your passive strategies, because passive strategies in the Canadian market are very carbon intensive. So it's going to increase a little. It will increase. It could increase over time your investment fees. But so we use a zero fossil fuel active strategy from Jarislowsky Fraser. We had a fixed income growth strategy that had exposure on emerging markets. We got rid of that strategy and we replaced it with a green bonds strategy that from Alpha Fix, which is in Montreal. So green bonds will provide you negative emissions, right? Because they're doing positive things. So it helps you with your footprint. And then you can read the rest. I guess I won't go into the details, but so we did this without changing the risk and return and the profile and the asset allocation in our investment policy, sorry. So this was all done without changing our investment policy that had been changed in 2021. So it's just I guess my conclusion is, once you get alignment from your board, your leadership, your investment committee, and you find the right providers, suppliers to help you, it goes very quickly. But it's frustratingly, if that word even exists, frustratingly slow at the beginning, and so you need to have a clear commitment to continue. And I guess there's a last slide. I'm not sure if there's a last one. Yeah, that's how we are structured now, just as a reference for participants.
Fantastic. Thank you so much, Karel. And the slides will be sent out to everybody, so you'll be able to refer to that to this slide as well. Continuing on that thread, I'm so pleased to welcome Ayo Olatunji, Director of Responsible Investing at CMA Impact Incorporated of the Canadian Medical Association. Ayo leads ESG integration and stewardship for CMA Impact's investment portfolio. And before joining CMA, he spent 7 years at BMO Global Asset Management, where he focused on sustainable investment strategy and also worked in the BMO's sustainability office. Ayo holds a degree in economics from the University of Manchester in the UK and a master's in finance from Queen's University. He's a qualified accountant in both the UK and Ontario. Beyond his role at CMA, Ayo contributes his expertise as a community board member at the Hamilton Community Foundation and as a member of the Industry Advisory Panel for Climate Engagement Canada. Over to you, Ayo.
Thank you, Ari, and thanks for having me, and I'm happy to meet everybody here this afternoon. I joined the Canadian Medical Association in 2021, and very similar to Karel, in terms of carbon footprinting, that was one of the first things I was charged with, and I had never previously monitored a carbon footprint. I never calculated a carbon footprint or assessed an investment portfolio carbon footprint. So totally agree with what Karel said in terms of it could be a little bit nerve-wracking at the beginning. The very best advice I was given at that time by my manager was to just get started. And that's the best thing which I think one could take when it comes to integrating carbon footprint into your investment approach, because I think it's one of those things where you learn as you go along, and as you go along, you'll refine your approach to it. So at the CMA, and the CMA is an advocacy group on behalf of the physician community across Canada. We have a focus on healthcare, the healthcare workforce, the health system, and what we call population health, so the health of Canadians. So at the CMA, we have a net zero target for our portfolio to be net zero by 2050, with 2 interim targets shown on the green line, with a 33% reduction by 2030 and a 2/3 reduction by 2040. Our baseline year, so the year where we started calculating our greenhouse gas emissions, was 2019. So with that in mind, starting from 77 tons of CO2, so ignore for now, if you will, the meaning behind the numbers, but the objective is to get down to 0 by 2050. So 2 milestones which I do want to highlight. Firstly, we've reduced our carbon footprint by almost 40% since 2019, as at the end of last year. And secondly, we're about 25% ahead of where we expected to be at this time. So two areas where we're very happy about, 2 areas where we're very proud about. But behind this good news story, as I mentioned, there was a lot of trial and error in terms of what we calculate, how we calculate it, and actually where to source the data from. To put more flesh onto the bones regarding this, the way we calculate our carbon footprint is by using a proportionate share of the greenhouse gas emissions of each company we invest in that we own. So that's how we calculate our carbon footprint. And in terms of calculation, there's 2 main approaches one could use to get the data. One is by using a third-party software provider, of which we use one. But secondly, and I encourage everybody here, do not feel reluctant to obtain some of this data from the asset managers you work with. Sometimes that can be a little bit tricky in terms of aggregating the data, but yeah, those are the 2 main approaches. So if I go to the next slide, please, Ari. So there's 3 levers that we consider in our investment policy, which are related to carbon footprinting. The first one is, how do we integrate climate and ESG considerations into the way our external managers manage our portfolio? Secondly, what avenues are our managers using to demonstrate externally their commitment to addressing climate change and through their engagement activities mainly? And thirdly, the use of investment restrictions, which is where I'm going to start from. So if I go to the next slide, please, Ari. So to be totally upfront, in terms of those reductions, which I talked about 2 slides ago, the biggest single driver of that reduction in our carbon footprint has been our investment restrictions. In 2021, CMA decided to exclude totally from our portfolio investment in companies whose primary business is dependent upon fossil fuels. So what does this actually mean in practice? So the graph on the left is an illustration of this. It depicts what we call sectors. So the 11 sectors of which every investable company is a member of. So every company you think of will be allocated to one of these 11 sectors on the wheel that you see on the left. The part which I've pulled out, so the blue little section to the right, is the energy sector. So that's about 4% of the world's stock market value. So really what this means is that the pool of securities, which our asset managers can choose from, is reduced by that 4%. We applied this restriction in March 2021 and immediately saw a huge reduction in our carbon footprint. In terms of how we apply those exclusions, that's kind of illustrated to the right. So as I mentioned, the first thing is we excluded the GICS energy sector or the energy sector. So to be a little bit more precise, that excludes all exploration and production companies within energy, but also within energy, for companies that are not involved in E&P, we have a revenue threshold. So where their revenue is more than 50% tied to oil and gas, they're excluded from our portfolio. The reason for that is because, and this really comes down to the nuance, we want to make sure that renewable energy solutions are allowed in our portfolio. The second thing I want to highlight, where it gets a little bit tricky as well in terms of which vehicles it covers, and Karel kind of alluded to this. I imagine many of the people in this call, your asset managers, your funds will be in what we call pooled accounts, where your money is pooled with other investors. It can be really, really difficult to express your investment restrictions in pooled accounts. So we have a threshold where we say within those pooled accounts, which could also include ETFs, we allow energy names up to 10%. When it gets above 10%, we'll look to possibly change that manager. Most of our assets are in what we call separately managed accounts, where we have direct investments and there's allowed to a lot more customization. Within those separately management accounts, our investment restrictions apply 100% fully, with no, deviations from that. Going to the next slide, please, Ari. So exclusion is one driver, probably, as I mentioned, the biggest driver of our reductions. The second driver is in terms of comes from the way our asset managers manage money. So I really can't emphasize enough how important it is choosing the right manager. So we put a lot of effort into integrating ESG in general, but climate specifically questions into our due diligence, where we're looking to onboard or look to select new managers. The good news is there's a lot of open source resources to use where you can get real detailed and specific questions to include in your due diligence of managers or your selection process of managers. I've highlighted a few of them to the left. One which I really want to highlight specifically is an organization called SHARE, which stands for the Shareholder Association for Research and Education. They have a really, really good open source due diligence questionnaire, which is very modular in format. So you can pick and choose the questions from there, which you find the most relevant. And I think once you use those questions, it really helps you to see how the asset manager is thinking about decarbonization, helps you to kind of understand their commitment to it as well, and how they integrate climate change and sustainability into their selection of the companies which ultimately are going to be in your portfolio. The net impact from us is that our asset managers are actually selecting companies who are truly decarbonizing. So we see certain names in our portfolio, certain securities in our portfolio where we can see year over year a reduction in their GHG emissions, which is what we want to see. Go to the next slide, please, Ari. And finally, on the same tune in terms of talking about asset managers, a good indicator for us in assessing our asset managers and how well they're addressing decarbonization as well as climate risks is through their involvement in formal joint collective climate commitments. So we expect, again, in our due diligence of managers, for them to show some commitment to these initiatives. Often, but not always, this comes with expectations from them, but it always comes with activity. So for them to be part of these collective groups where they come together to work on real world decarbonization, I think for the most part, it is a good signal in terms of how well or to what extent they consider decarbonization. So a few of them are illustrated at the bottom. One is called FAIR, which is related to protein diversification, and decarbonizing the food system. Climate Engagement Canada, which is focused on the largest GHG emitters in Canada. We also have the Clean Air Initiative, which is focused on pollution, well, air pollution specifically, and then Nature Action 100, which is focused on biodiversity. We would typically, when we're looking for a new manager, we'd typically ask them, are they involved in these initiatives? And if not, we'd expect them to illustrate to us what they're doing individually in lieu of that. The final thing I mentioned is that we're also a part of SHARE, who I spoke about in the last slide. Really good, really great organization of many progressively focused managers of capital, managers of capital and foundations and not-for-profits. Highly encouraged to look at some of the resources they have and to be tapped into the community which they have, which has helped us to also consider which asset managers that we want to select for our portfolio. So one more slide for me, Ari, please. So just more broadly outside of climate, some of the other areas we look at as a health organization are really seeing where our asset managers are looking at other societal issues, and particularly those related to health. And we really ask them very detailed questions and really conduct relatively detailed assessment of to what extent they're integrating these expectations into the companies which they select. So some of the areas which I want to highlight, for example, is AMR, antimicrobial resistance, which is a growing threat, not only in society, but to the value of all of our portfolios. Nutrition from some of the food and beverage sector, and access to medicines and access to vaccines, which again, left unchecked, could have severe health repercussions, but also once again, tying it back to a potential loss in the value of a portfolio. So we look at those issues, assess our managers against them, and see to what extent they're using our capital and our money to address some of these issues. With that, I'll give it back to Ari.
Thank you so much. Thank you, Ayo. Just a quick reminder to everybody, we'll have time for discussion and questions at the end. So now we'll turn to our partners at Quinn & Partners. We'll introduce the community of practice. Joining us, we have Rosalie Vendette, director at Quinn & Partners and a responsible investment expert with over 20 years of experience, helping asset owners embed sustainability into their practices. For 10 years, she served as the responsible investment spokesperson at Desjardins, where she led the implementation of ESG integration strategies, including the fund's first carbon footprint review in 2014. And Rosalie is actively involved in several key industry initiatives, including the Canadian Pensions Dashboard for Responsible Investing and the development of the upcoming ISO standard on sustainable finance. Over to you, Rosalie.
Thank you, Ari. It was great to hear Karel and Ayo share their experience. I am the one that speaks now, but I am also joined by my colleague Francisca and Sam, who are also on the call. So any of us can jump in to answer your questions when we'll get to the Q&A. As Miles was saying at the beginning, this initiative, the LT Capital Program, is really about empowering hospital board foundations members, foundation staff to progress on their sustainable investment journey. We believe sustainable investment is a way to safeguard long-term returns and align the mission of the foundation with its investment activities. And so we've imagined several tools to help out throughout this 2-year program with awareness sessions. Some of you might have some of the awareness sessions already booked. What we'd like to talk about here is really community of practice. And so the community of practice that we've imagined is a group, essentially a group of hospital foundations participants coming together to share, to discuss, to exchange. We believe this could be a great way to learn from one another, to exchange on challenges. Some of them might be common opportunities. We were able to identify some of them earlier on when we did the survey landscape and presented the results. But we also want to take it further a bit in co-creating practical tools, frameworks, or guidance material that the participant will say are going to be useful for them. Through this community of practice, you have access to experts that are going to be able to help the co-creation process. And hopefully this will support capacity building at literally every hospital, foundations throughout Canada that is interested to learn and can take from those tools. So if we go to the next slide, we'll see what the various inputs, outputs can be. So I've mentioned the tools, essentials to the learning, and probably Ayo and Karel can testify to this. If we piggying back on what they said, some of examples come to mind. For example, due diligence. Ayo shared some of them that are out there. It can be a tailored to specifically to hospital board issues due diligence questionnaire with select questions to ask your investment manager. It could be a set of investment beliefs to choose from that could be added to your investment policy. A tool could be a template investment policy, sustainable investment policy, so that you have text that you can choose from and adapt for your own needs. The list could go on, and it's literally for the participants of the community of practice to be able to tell us what will be useful. But it's not only about tools. I think the community of practice will be able to showcase case studies. It might be studies on financial performance, on specific issues and how it can be tackled, on what's out there. Anything that demonstrates real world application and how it can be adapted to your context. We think that through the discussion and the exchange, there's going to be peer learning happening. So we'd like the community of practice to become that forum where organizations get to know one another and use those relationships to learn a bit more and exchange. And hopefully this will provide also guidance for governance and oversight. And ultimately, what we envision the community of practice to have at the end is a set of tools that will be available in French and English and will be posted on the LT Capital Program website. So what's the value for you? As participants or potential participants, you might be wondering, like, what's in it for me? We think that it's through this initiative, you gain access to expert advice, fully funded by the program. You can learn from others, from those that you trust that are experiencing similar situation and have a similar mission, having to, on one end, respond to donors, appeal to more donors, and on the other end, helping the hospital or the institution that you support further their goals. We think that you'll have access to tools that are going to be ready to use, that you can be tailoring them. And we hope that it also gives you, through the learning process, more knowledge so that it builds your confidence as advisors for the board. You might be wondering why is this going to take a lot of my time? What's going to be needed from me? So on the next slide, we've anticipated those questions. Oh, sorry, I'm ahead of myself. You can go back. So you might be wondering who will be enabled to participate to this initiative. And we'd like to say it's really open. We'd like it to be as flexible as possible for hospital foundation. So it can be interested board members or delegated board members. So representatives that will be reporting back to the board. It could be investment committee members. We know that sometimes some of those are external, so it doesn't have to be board members necessarily, and it can also be the foundation executives. any participants with an interest and the ability to participate and exchange with other participants, like-minded participants. And we believe that those people will acquire knowledge that will then can bring back to the institution they represent. But it also is good knowledge that they can use also for personal values for their own personal life. So we've outlined some of this, and we invite you to consult this when Ari is going to share the presentation after. So in terms of time commitment, on the next slide, we've envisioned 3 to 4 meetings, and we believe those will start in the fall next year. So over, I'd say, the second half of 2025 and the first half of 2026, we've imagined meetings of 90 minutes each, about quarterly. So all you would have to do is participate to those meetings and prepare for those meetings. So most probably having pre-reads, being able to provide feedbacks on draft deliverables, provide input so that the tools can be co-created throughout the process. And we have a little bit of a timeline on next slide where we would like to kick things off with formal expression of interest for the first, before the first meeting. So between now and September, Ari is going to reach out and see if that's something of interest to you. And so hopefully we can kick things off sometime in September and have 3 other meetings towards the end of the year, beginning of next year, and March 2026, so that we can go back, polish the tool, finalize them, translate them to have them both ready in French and English. I think that's it for me, and I hope we'll have the opportunity to answer any questions that you have. Over to you, Ari.
Thank you so much. So with that, I guess I'll stop screen sharing and I will end the recording.